Good morning, everyone, and welcome to today's webinar hosted by PYA. Today, we are continuing our PYA Perspectives series with a presentation on private equity physician deals, what investors, physicians, and hospitals need to know in 2022. PYA is happy to present today's webinar in conjunction with McGuireWoods. Before we get started with the webinar, I'd like to go over a few housekeeping items. As this event is for CPE and CLE credit, there are some additional steps that we will take in order to comply with the governing association's requests. Attendees will be provided 3 polling questions throughout today's webinar. Responses are documented electronically. Attendees must respond to these polling questions within the allotted time in order to receive CPE or CLE credit for this course. A post-event survey will also be provided for attendees to submit regarding their webinar experience. The polling questions and the post-event survey must be submitted for proof of participation today. You will have the opportunity to submit questions to today's presenters by typing a message into the question pane of the control panel. We'll collect these and address them by email after the webinar. All of our webinars are recorded and released with a copy of the slides after the event. With that, I would like to introduce Michael Ramey, Principal at PYA, Kristen McDermott Woodrum, Partner, and Erin Dine, Associate at McGuireWoods.
Thank you, Laura. This is Michael Ramey. As Laura mentioned, I'm a principal with PYA in our healthcare consulting services practice. I lead our group called Strategic and Transaction Solutions, which includes our transaction advisory services. Involved quite a bit with the constituents that we'll be talking about on today's webinar. I'll turn it over to Kristen and Erin and let them introduce themselves as well.
Thank you, Michael. So happy to be here, and thank you to you and to PYA for the opportunity to participate in today's webinar. I'm Kristen McDermott Woodrum. I'm a partner in the Atlanta office of McGuireWoods. I'm based in Atlanta, but work with our national healthcare team and clients across the country. I focus my practice on healthcare transactions and regulatory matters, and I've been on all sides of these deals over the years. We have a deep healthcare and transactional bench at McGuireWoods, and I'm thrilled to turn it over to a true superstar associate, Erin Dine, who I'm fortunate to work with on many PE physician transactions.
Thanks, Kristen. Yes, I'm Erin Dine. I am in the healthcare department sitting here in Chicago. I focus my practice on private equity-backed investments in the healthcare industry, but my practice touches both regulatory and compliance issues in that industry. But we look forward to presenting this webinar to you today.
Thank you, Kristen and Erin, and we are delighted to have a partnership with McGuireWoods on this webinar. So our agenda for today will include, first of all, a bit of a setting of the landscape. We'll talk about some of the recent deal trends that we're seeing within the healthcare industry, and then also transition a little bit into talking about potential partnership paths that sellers of physician practices and ambulatory services can pursue, and the activity that we're seeing right now happening there, including emerging trends in healthcare acquisitions. We'll also then turn attention more towards the legal aspect. I will ask Kristen and Erin to speak a little bit about the structuring of these transactions, and specifically MSOs and how those are utilized to affect these transactions in a legally compliant way, and various different considerations in actually structuring that. And then we'll close with some various different affiliation models that we're seeing between investors in healthcare services, including MSOs as well as health systems, and then also some key pitfalls to avoid throughout the process. So if we start off, let's talk about some of the recent trends that we're seeing. The graph here shows all U.S. private equity deals in healthcare since 2015. And as you can see, 2021 was a record year for private equity investments in healthcare. If you are in the professional services space, I think we all felt that. It was a feverish pace last year, especially at the end of the year. Some of that was the catalyst of that was questions in regard to potential tax reform, what that might mean. So a lot of activity there, but still a very attractive market for investments, and we'll kind of touch on why. That was coming off of 2020, which, as you can see from an actual capital invested, was a low point in recent years, predominantly because of COVID and the uncertainty caused there. However, from 2019, there actually was an increase in transactions, which means smaller transactions being consummated, more tuck-ins. And then we look at 2022. 2022, this is, as you see on this graph, is annualized. Right now, through mid-August, we're at about 597 deals within healthcare U.S. private equity at about 47 million in capital invested. So we've annualized that if that trend continues, and it's projected to decrease off of the highs of 2021. I think some of that may have to do with cooling a little bit. In terms of questions on interest rates back in the summer. Many that I've talked to saw that both on the buy side, sell side, as well as the professional services side in the summer months. It seems that tide is turning a little bit, quite a bit actually, and we're kind of set up for a busy second half of the year. There's also questions out there in terms of, given the 2021 activity, what's the supply of attractive assets at reasonable multiples? So I think there's a little bit more selective buying going on right now. And there's also some uncertainty, which we'll talk about briefly here later on in the webinar, in regard to reimbursement. You've got the healthcare labor market, which is just crazy right now in terms of the higher costs of labor that everybody's feeling, but especially within healthcare, with the attrition of a lot of that labor force, the clinical nursing staff out of the workforce, as well as other inflationary pressures. And some of the buyers I'm talking to, at least on the larger transactions, are taking a bit of a cautionary tale at this point, trying to preserve some capital because of some of those reimbursement and those cost pressures that they're feeling. So a lot going into that. I think 2022 will still be pretty good year. I think that the back half of the year is structured well, but likely not going to hit the 2021 deal volume that we saw. Breaking that down just a little bit. First of all, this captures all private equity and M&A control transactions and breaks it down between the sectors. So still healthcare services is a predominant activity here. 2022 is also annualized for purposes of showing some comparable numbers, but a lot of activity going on. 2021 was still, as we've mentioned, very, very active. Some notable transactions include the Walgreens acquisition of VillageMD back in 2021 for $5.2 billion. Walgreens is aiming to actually create up to 600 primary care locations additional primary care locations by 2025, and this is to help fuel that. There's also activity in other sectors. You see, actually, we'll break it down on the bottom of this between clinics as well as other providers, clinic and outpatient services, which are still the predominant subsector within the healthcare services sector. So a lot of activity there. But we've also seen some things, massive deals, such as what played out with Medline going from private and private family owned into ownership of private equity last year for over $30 billion. We saw the acquisition of Athena Health by Hellman & Friedman and Bain Capital for $17 billion. That was in the tech-enabled space. So a lot of activity in these various different sectors. Within the clinic and outpatient services, we're still seeing a lot of activity in surgical specialties. And chief among those, I think, still are ophthalmology and GI, at least from our vantage point, but still some additional investments going in to areas like cardiology, orthopedics that we're seeing. And there was a large orthopedics practice acquired in Atlanta over the last year by private equity. So a lot of investments there. Veterinary still remains hot. We're seeing more in home health and hospice at home, telemedicine, and virtual primary care, just to name a few. So we've talked about the deal volume. Now what about pricing? So this captures some information in terms of multiples over the years, and you see a pretty steady increase, and especially at the top, as you see those higher multiples are actually associated with the higher dollar value transactions, and that suggests these platform companies are still commanding high multiples and even growing. That may be due to scarcity. Now, logic would suggest that when interest rates increase, your weighted average cost of capital is increasing. The inverse of that are multiples. They should be decreasing. We're not seeing that play out yet, at least not in 2022. We'll see what happens as the Fed continues to adjust those interest rates in effort to curb inflation. But as of yet, the multiples have remained somewhat consistent, starting to decline a little bit in those lower value deals. And I will note just a couple things here in terms of the multiples that are driving here. You see on the right-hand side, those are specific to physician practices and specialty clinics. The right-hand side is specific to healthcare in total. We've got some really big transactions that are playing into to the high multiple in 2022, and it's rather small amount in terms of the total volume. But some things like KKR's investment in the fertility treatment entity of in Burma, and then also Kinderhook Industries investment in the primary care and MSO provider Physician Partners is driving a lot of those higher multiples associated with that. I would say that on the lower value deals, supply still seems to be really hot. I'm hearing from lower middle market investment bankers that in their development efforts of these entities that probably don't quite meet the platform level, even for physician practice subspecialties, but more of those tuck-ins, it's been as hot as ever, even causing them to be more selective in volume. And I think that's going to continue. One thing that I found interesting, many of you all may have seen the Bain and Company 2022 Healthcare Private Equity M&A report. It's a very informative report, but one thing that's really stuck out to me in that, and I've seen it in multiple presentations actually, has been taken, is that the deal value creation on healthcare service, or healthcare deals from 2010 to 2021, they did a study that half of that is coming from revenue expansion. Interestingly enough, most of the other half is coming from margin expansion. I'm sorry, from multiple expansion, and virtually nothing is coming from margin expansion. So that suggests there's a need to continue to build these entities on the top line through expansion of tuck-in models. So I think that dark blue level will continue to be at least voluminous into the future. Question is, why is there so much activity in this area? Well, a couple things that are contributing to that. First of all, and some of this is taken also from that Bain 2022 M&A report, has to do with investments and how attractive they are from an internal rate of return. They disclose that since 2010, healthcare returns have consistently outperformed other sectors, other industries. So we've got about 27% return on healthcare investments versus 21% over that time. Healthcare spending is projected to continue to grow at 5% annually. And then while there's definitely a focus on consolidating lives, consolidating services, growing bigger, there's big investments going on, we got mega deals. At the end of the day, healthcare is still local. So there's a little bit of insulation from external threats from there. Because it's local, that's contributing to it's highly fragmented. And fragmentation presents opportunities for roll-ups and creating efficiencies. We're going to continue to see increased demand, according to the Administration on Aging, which is a division of HHS. In 2019, 16% of the U.S. population was over 65. That's the highest user, of course, of health services. In about 2040, it'll be 21%. So that's going to continue to increase. And we continue to see integration across the care continuum, whether it's acquisitions of tech-enabled solutions to support primary care platforms, or corporate buyers extending into ambulatory and other provider services, as we've seen with United Healthcare, with its Optum subsidiary over the last decade. There are opportunities for continued integration there. And by and large, it is recession resilient. Are we in a recession? Are we going into a recession? I don't know. I'll leave that up to the economists. But the fact is that many of the first dollars spent, or at least for employees, are going to be on healthcare. That is the way it works. And so that makes it more attractive than other sectors. So we now go to our first polling question. So again, to get CPE and CLE credit, we ask that you now answer this question, and I will turn it over to Laura.
Thank you. Our first polling question is, what is your deal flow forecast over the remainder of 2022? As rapid as ever, steady stream but slower rate than 2021, intermittent bursts for attractive assets, or slowing to a trickle? Remember, you must fill out the polling question in order to receive CPE or CLE credit. You'll have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand it back over to Michael.
All right, thank you, Laura, and everyone should be able to see the results here. So that's really not surprising, I don't think. Steady stream, but slower than 2021 leads the voting at about half. With intermittent bursts of attractive assets, we're seeing that certainly in mega deals. Very few are saying it's slowing to a trickle, so that's interesting. Thank you for participating in that. All right, switching back over here. The next thing we wanted to talk about has to do with physician practice ownership and some of the factors that are contributing to consolidation. So first thing I'll mention here is this is a brief portrayal of the breakdown of physician employment. So still the predominant employer of physicians are hospitals and health systems, but private equity, corporate entities are growing. Only 1 in 4, approximately, physicians are still in independent practice. Kristen, did you want to weigh in on this one as well?
Yeah, so we pulled this data from a report released this spring. It was a study commissioned by Avalere Health and the Physicians Advocacy Institute, which is a nonprofit organization that advocates for physician practices. And it focused on the 3-year period between January 1st, 2019 and January 1st, 2022, and specifically looked at the impact of COVID on transaction activity. And as you can see, we now have pretty staggering stats on our slide, but the number of employed physicians grew by about 19% over this period, and 70% of the shift occurred after the onset of COVID. So that represented some acceleration. Acceleration, especially on the hospital side, the number of physicians employed by physicians grew by 11%, and we saw a really steep uptick starting in about July of 2020. And then on the PE corporate side, this is private equity as well as other corporate employers, think Optum, Walmart, any non-independent physician practice. That rate grew more steadily, but it had a greater overall increase. And I think the employment grew by 43% in the same period of 3 years, which I think is pretty dramatic.
Great, thanks, Kristen. So let's peel that back a little bit as to why people are looking for other opportunities for partnership and seeking capital partners. So, some of these things listed here, shifting financial risk is probably one of the more prevalent ones. You've seen the proposed 2023 Medicare physician fee schedule that's been released. That suggests a 4.4% decrease, at least in the conversion factor, which should reduce the reimbursement. Now, we'll see what that ends up being on the final. Historically, the final has been much closer to the prior year. Back last year, that was adjusted, but that was due to a one-time 3% adjustment enacted by Congress. So it could take legislation to be able to affect that again. At some point in time, we're going to continue to see that downward pressure. Also, COVID, as Kristen mentioned, greatly affected practices, especially those who were too big for PPP proceeds. So I think that breached some risk tolerance levels for many physicians, and most physician practices are structured as professional corporations, in which, from a tax perspective, you've got to bonus out everything at the end of the year to avoid double taxation. And in such cases, there's not that cash nest egg to be able to fall back on. So it's a direct, immediate impact to those incomes. So they're thinking about other opportunities. There's also the administrative burden and consistent regulatory burden. From an administrative burden, the question I hear most from providers right now is, when will the labor market stabilize? Will it ever return to pre-pandemic levels? I don't know if it'll ever return. I don't think it's going to return anywhere close in the short term. And this is beyond just RNs. This is med techs. This is office staff. Those that honestly are at levels that many of other industries are increasing levels to and driving up competition. You got regulatory burden. You got E&M coding that's changing next year. That's going to impact the compliance posture. So always trying to stay on top of that. And in many cases, practices just don't have good succession planning. They aren't built to be multi-generational, and the current market provides an attractive exit opportunity compared to the typical normal buyout provisions that are in an operating agreement for a physician practice. So a lot of activity here. So if we think about the why, now let's think about the who. So going to sell, who are the suitors? Of course, you got health systems and private equity, but we have to add payers to the list. Not sure. Do you know who the largest physician employer is in the nation? It's actually Optum, owned by United Health. Optum employs over 60,000 physicians now, over 2,000 locations. That was bolstered by its recent acquisition of Altreus Health up in Massachusetts, added 715 physicians at a purchase price of $236 million. So a lot of activity there. You still got PE, that obviously is big. Now, what this is meant to do is contrast some of the objectives of the different parties. Private equity is focused on trying to build scale, create efficiencies through a platform, through tuck-in acquisitions, and then ultimately exit through a liquidity event. The private equity funds have a defined timeline. So you raise the funds, you invest, you have to turn those, and usually it's 3 to 7 years, pretty much on a single investment from a hold factor. And that's another reason why I think the activity is going to continue, is there is a lot of dry powder out there that has to be invested per the terms of these agreements. So we'll continue to see that. And then you got contrasting that within health systems. So health systems are more focused on targeting to fill gaps of services in the care delivery. They're not playing for an exit. They are planning to acquire and integrate. Not as focused on some of the scale and the efficiencies, but I will say that they are highly focused on fraud and abuse, because physician or medical group is going to comprise usually a small portion of a total health system's revenue. And you think about the impact on downstream referrals for services, including ancillaries, and health systems many a times are going to be more conservative in their transaction structures for physician practices than private equity and payers, because there's just a lot at risk from a revenue perspective. Erin and Kristen, I'm not sure if y'all want to weigh in at all on that.
Yeah, no, that's absolutely true. I think hospitals, because of the regulatory framework and other factors, are more limited in what they can offer these physician groups. And then they're more bureaucratic. And so physicians lose a lot of autonomy when they go to a hospital. So what we've seen with our hospital clients is a variety of different alignment strategies, ranging from employment to PSAs to trying to achieve some of their objectives by maybe hosting a clinically integrated network. That way you have the benefit of some alignment, downstream referrals, and ability to build out your payer network, but without necessarily getting married to the physicians through employment if they're not biting on that offer.
Great, thanks, Kristen. And just on the other side of the equation, the physician seller needs to know all these arrangements are going to have restricted covenants. You're going to lose autonomy, usually in the inverse proportion to how big that check is. So, just know that going in, and they're all structured differently in terms of length of compensation, length of employment contract, coupled with adjustments to compensation, depending upon what the objectives are of those different constituents. Want to touch briefly on just some considerations, and this is important for both seller and buyer to understand. A lot of times physicians come in, they know they want to do a deal, but they're not really equipped for what they're about to encounter in terms of actually getting through to a close. And often buyers are somewhat immune to, or they've done so many of these, may not be able to appreciate some of the impacts on the physicians, but making sure that there's commonality and expectations is important. A due diligence process is going to be challenging usually for these groups, because you got financial, legal, compliance, due diligence, preparing them for that. Under an asset transaction structure, you got the physicians thinking about or finding out, okay, I've got to figure out how to wind this entity down. I've still got these residual obligations associated with the current legal entity, and retain liabilities, paying off debt, things like that. Setting those expectations up front is important. There's expenses that may not be understood and appreciated up front that are going to reduce that total deal value, including requirements for tail insurance, getting transaction counsel, getting transaction advisors, as well as refs and warranty insurance, which continue to be prevalent within the market. So all of those things, in addition to true ups on the back end regarding escrowed funds and net working capital, are impacts to these transactions. So now we've talked about kind of the transaction. Now let's switch gears a little bit as to what we're seeing in healthcare investments, and then I'll turn it over to Kristen and Erin to talk about some of how to actually structure this. But this is important to understand also for corporate buyers and private equity, because there is more activity coming in to healthcare, and it is from some really, really deep pockets. Not to say private equity isn't deep pockets, it certainly is, but there's some big players here when you talk about United Healthcare and Optum and all that they're doing. We touched about that briefly, but now you've got Amazon. As recently as this week, we heard about the news of the bidding war between Amazon and United and CVS for Signify Health, which is a home and community services and episodic care provider. So you've got that activity. You've got Amazon coming in with One Medical, which is a primary care platform. A lot going on here with corporate disruptors that are even further, at least on the large deals, driving further competition. Kristen, did you want to add to that as well?
Yeah, there's been just so much activity to follow in this area, and there's a lot of competition, particularly in the primary care space. We have, obviously One Medical and the acquisition by Amazon will be huge. And also in that area, we've got VillageMD, Walgreens, Walmart, all starting primary care clinics and competing with those who want to have the same populations for alternative payment models and ACOs and capitated risk under Medicare Advantage. And so it's very interesting on the primary care front. One thing that I found interesting about One Medical, they had acquired Aurora Health, which was focused on Medicare Advantage risk-based contracts. And so it'll be interesting to see how they evolve in that direction under Amazon. And they also have contracts with health partners, health systems. So presumably participating in some of their networks and payer contracts, which I think shows sort of an area where these disruptors can fit within the system and work with hospitals versus being just, head-to-head competition.
Great. Thanks, Kristen. And as we talk about that, I mean, consumerism is a word that's been around a long time in healthcare. It's kind of gotten popular and then less popular, and maybe it's getting popular again. But anything that has to do essentially with, as Kristen just mentioned, meeting the patient where they are, be it telehealth platforms, primary care, additional access points, all of that, we're seeing activity continue, digital solutions, integration between the different ends of providing that care is also a lot of activity going on. We've talked about digital health. We've talked about what we've not talked about necessarily is value-based care competencies. We're seeing anything that can shift from just a traditional fee-for-service into more risk-based, value-based care through aggregation of populations and through application of technology is really a value add right now. So we're seeing much higher multiples and interest in those entities that can go, direct to consumer through those different value-based care competencies, and in some cases using CMS-specific care models to be able to deliver that. So one more thing here from a activity perspective before we get into our next polling question, which is again speaking to some of the activity that we're presently seeing in the space. Still, surgical specialties are hot. Primary care, we mentioned. Outpatient behavioral, we've not spoke as much about that, but behavioral is an entity just from a national healthcare perspective that's getting a lot of attention, and we've got to fix the reimbursement structure, but there's some innovative models that are coming into that to be able to do it. And we're seeing more private equity investment. KKR set up a company, Geode Health, for purposes of aggregating outpatient behavioral. Rural health is another one that we're seeing activity in. Some of that is sparked off of adjustment from a reimbursement perspective. Instead of cost-based, now it's an all-inclusive rate or an AIR rate, and that's actually projected over the next 8 years to increase by 90%. So that's attractive to some investors who can control costs and be able to make that proposition work. So let's go to our next polling question, which is, I will turn it over to Laura.
Thank you. Our second polling question is, what area do you expect to invest the most in the next 2 years? Physician specialty roll-ups, behavioral, home-based care, new care models and capitated arrangements, healthcare tech-enabled solutions, or telehealth? Remember, you must fill out the polling question in order to receive CPE or CLE credit. You'll have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand the presentation over to Kristen.
Kristen, you were muted inadvertently there.
Thank you, Michael, and thank you, Laura. Looking at the polling question, it looks like we had tech-enabled investments sort of slightly ahead of the others, with new care models and capitated arrangements coming in on its heels, physician specialty roll-ups, behavioral health kind of lagging, and then home-based care kind of at the tail, which I think is interesting. I'm seeing movement in all those areas. Wondering if kind of the telehealth and the tech-enabled will start to slow down and the others pick up, but we're not entirely clear that's going to happen. So I think now we will start to focus in on some of the core considerations in structuring a transaction. Let's see if I can get to the right slide here. Sorry, guys.
I'll back you up. Go ahead.
Yeah, keep going back. Yeah, there we go. And so we're going to start with the basics, really high level. And Michael and Erin, please jump in here. We'll try to go pretty fast so we have time for the mechanics at the end. But first, who's participating in these transactions? It's a PE fund. This is the money driving the investment. We won't get into the upstream fund structure, which is pretty complicated. It typically involves a general partner, outside investors who are limited partners. They commit the capital, and fund managers. Note that the investors may secure a credit facility for this investment. So keep in mind, which entities are in the obligated group that can impact your transaction and operations. Obviously, there are tax and economic considerations that are going to impact what these investors are doing, as Michael alluded earlier, looking at interest rates and the continued availability of carried interest tax treatment. Also, keep in mind that a lot of these PE firms have different levels of experience in healthcare, and having experience in healthcare is really key to driving value and smooth operations. I feel like everyone got into healthcare, and maybe our 2021 numbers show that. And so there's definitely, I think, a differentiator between those with experience and those that don't have it yet. Moving downstream, we've got the parties who are involved in the transaction, which can include a management company. We'll talk a lot today about an MSO, or management services organization, a physician practice target. This is our seller entity. And then we'll typically have a professional entity as part of the deal structure that will acquire either the assets or the equity of the target physician practice. If this is a platform transaction, we may need to set up a new co. Otherwise, the platform practice entity will generally serve as the acquiring entity. Next, some of the business considerations just at the outset of the deal include the current operations of the target. Does it currently have a management company? What is the structure? Are there multiple entities? Is this a super group we need to look at and see, is this really one group or kind of an amalgamation of a bunch of related businesses? These factors can influence diligence, structure, and then also our timeline and conditions for closing. And then our investors will typically start with a bigger practice with more infrastructure to anchor the transaction. This is the platform. As noted earlier, you usually see higher multiples, keeping a lot of the infrastructure, including payer agreements. There are regulatory advantages to having just one platform in a given area. We'll run through some regulatory highlights in a minute. And this is a tricky conversation as deals go on, and physician groups figure out, are they a platform? Are they a bolt-on? What does that mean? Are they getting the same deal that someone else got? Are they losing autonomy in their practice? The next sort of big consideration is equity versus asset. Economic terms are obviously very important, both to the sellers and to the buyer. Most of the platform deals seem to be equity transactions. It's more advantageous to the sellers from a tax perspective, and from a buyer perspective, enables you to sort of step into those operations, including payer agreements, more easily. And then I think a key piece of the economics is and Erin will probably touch on this, sort of the payment of the purchase price. It's not just a purchase price all paid up front at once. Rather, there will be purchase price in cash as well as rollover equity. So the physicians will, instead of owning kind of all of their practice, and they're going to own in a holding company along with the investors. So usually that's a holdco above the management company, and Erin will show you that structure. But having some skin in the game ensures the physicians are there to help grow and scale the practice, which is important to driving value. And then legal considerations, the ones on this slide are really just top of mind when we're doing the structure, and corporate practice of medicine is always the first thing we look at. There are many states that prohibit physicians from practicing, or that prohibit anyone that's not a physician from practicing medicine or employing a physician or other professional. It's a public policy sort of driven law protecting clinical professional judgment. So there's no layperson control, including putting profit interest over clinical judgment. And we want to make sure that clinical care is in the judgment of a physician, not an investor. Because there's so many states that have these on the books, we have to look and see, specifically whether we need to use an MSOPC structure. And there's an advantage in doing that. Our clients don't exclusively use it, but many times there's an advantage to using it. Certificate of need is probably the next thing we look at. These laws, which I think many, maybe a majority of states still have, are intended to control medical costs by limiting the supply of services and facilities to only what's needed as determined by a state agency, and is frequently opposed in administrative litigation by competitors. For physician deals, we're typically looking at surgery centers and expensive pieces of equipment, think like LINACs or MRIs. And so we need to look at the CON laws to figure out, is the CON transferable? Can a management company invest in an ASC? Will changing the physician structure somehow invalidate a CON or an exemption from a CON that exists? So very key to look at that up front. CON can delay the timeline of a deal by months and months in some states, or require a two-phased approach, or sort of a creative restructuring. Next would be antitrust. I think, all transactions are subject to antitrust laws. If you meet the Hart-Scott-Rodino threshold, you have to do the filing. I think it's 101 million this year, which can take some time. Also, even if you're not at that threshold, keep in mind that you're still subject to antitrust laws, looking at sort of your market concentration, and also thinking about how you're evaluating payer agreements and competitive information when you're in the same market. And finally, tax. We always bring tax counsel in immediately, have to determine how that target entity is taxed. Has there been an S election? Do we need to do an F reorg to make the deal structure work? And then what is the tax treatment to the parties? And then finally, kind of the key stages, LOI, that's where you're laying out the terms. I highly recommend bringing in counsel early for the LOI, in addition to just getting it structured and figuring out a realistic timeline. There are a lot of business terms that can go into LOIs that are hard to walk back, including things like burnouts, which Erin will talk about. And then also we would look at starting due diligence, sort of pre-closing. There are a lot of chow notices, credentialing, lender work that needs to be done in advance of the transaction. There's a whole suite of documents in addition to just your purchase agreement and your governance documents, employment. All those terms have to be worked out, including restrictive covenants, indemnification, drag-along, tag-along rates. And then post-closing notices, integration. Sometimes we pump things that we can into the post-closing just to get a deal done. And then I know Erin and I have worked with a lot of PE-backed healthcare companies of various sizes and stages, and they have growing pains. And so getting integrated, figuring out how to make it all work together is important in post-closing. All right, Michael, could you take me to the next slide? I'm not sure where I'll end up. This will be Erin.
Yes. Well, Kristen touched on a variety of different things that you have to consider when structuring a transaction in the PE space. I would say the threshold question we always ask is whether the applicable state does have a corporate practice of medicine doctrine. And like Kristen said, that doctrine in a state prohibits a professional, prohibits a non-professional from owning in that practice entity. So someone like me and Kristen, we can't own in a medical practice in states like New York and New Jersey. We have to set up a structure like you see on this structure slide, an MSO PC structure. And you'll see that the management company, which we call the MSO, owns all the non-clinical assets of the practice, and the practice owns the clinical assets. The practice also employs the clinical employees, and we try from a buyer perspective to include as many of the assets and control in the MSO as an applicable state will allow us to, because all of the value should be held at the MSO to the extent we can. This impacts and affects the business from an operational perspective. You can imagine the bank accounts need to be really considered in connection with this structure. The decision-making of the platform, making sure that no non-physician can make any kind of professional or clinical judgments that could impact the clinical decision-making of a professional. And so it's really important to look to legal advisors to structure a platform not only on paper correctly, but also in practice correctly. And I feel that in the industry, we talk so much about CPOM and MSO-PC structures, but we don't often talk about the consequences of what actually happens if we do this incorrectly. And I typically say the biggest threat is if a physician were to not want to abide by his or her non-compete and say this non-compete is void because the entire platform is unenforceable and illegal. That's number one risk. Number two is, of course, civil or criminal fines and settlements from a state regulatory agency. And then number three would be potential disciplinary action in connection with the licensed professionals. So most state regulatory regimes state that the licensed professional is prohibited from engaging in the unauthorized practice of medicine with other individuals. And so that's where if the structure is not set up correctly, it's the actual individual physician who could be on the line for those penalties and disciplinary actions. And then what we're seeing a lot more on the East Coast include payer challenges. So challenges by a payer in connection with this structure such that they don't want to reimburse services because the structure is void or illegal under the applicable state doctrine. So there are a lot of other legal considerations that Kristen will touch quickly, but we thought it was important to just level set and lay out the MSO-PC structure because it does flow through the rest of this presentation. Kristen, I think you can unmute too.
There we go. It's definitely not intuitive, and we've left a lot of boxes off the slide. Typically, we'll have a PowerPoint with 10 pages of just different entities and ownership structures and dollar flows. But for purposes of today, that's sort of the simple setup. And then talking about the regulatory framework, we've talked about CPOM. Keep in mind, as Erin said, it's not just relevant in structuring, but it has to be operationalized appropriately. Next, fee splitting. Many states also have fee splitting prohibitions that will prevent a professional, including a physician, from sharing professional fees with a layperson or entity. And this can impact management fees. So that MSO needs to get paid for providing the management services. Oftentimes they want a percentage because it's more flexible, but some states will prohibit that and we'll have to come up with a flat fee or other structure for the management fee. Then kind of skipping over to the right-hand column for a minute, provider enrollment, a CHOW analysis or change of ownership analysis has to be part of every deal, and coming up with the time plan for the filings, whether it's 855 to Medicare, CLIA 116s, all those regulatory notices. Don't forget about private payers and don't forget about credentialing. A lot of times on the add-ons, we're adding the employed physicians and other clinical professionals onto existing payer contracts, and that can be 90 to 120 days lead time to get the credentialing done. Billing and reimbursement, payers, especially federal and state programs, have very specific rules for billing and coding and submitting claims, And there are lots of risks associated with this, including specific risks depending on the specialty. So as part of diligence, we recommend getting a billing and coding audit. If you have a lender or you're getting reps and warranties insurance, they're going to ask about this. We have seen E&M codes all over the place this year, risk areas in pain management and just other specialties, looking at medical necessity. And I would say it's not just a regulatory issue, but making sure the practice will still be profitable if the billing practices change post-closing. Licensure is important, not just of facilities, but of the professionals, including those sort of friendly docs who are owning the practice that you're basing this entire investment on. We've talked about certificate of need, data privacy and security, including HIPAA, is an important area of diligence. And then state insurance laws come into play if there's retention of risk or any sort of TPA-like functions. And this is not an exhaustive list. I once had an ENT deal blow up because the practice was reusing single-use balloon for sinus surgery, which violated the FDA requirements, and it got them in a lot of hot water. And then finally is fraud and abuse. Kind of skipping back, federal and state laws, the INA kickback statute is very broad. It prohibits offering, paying, soliciting, receiving any remuneration for referrals, recommending, arranging, kind of any healthcare business that's reimbursed by federal programs. And it's a criminal statute, it's intent-based, but keep in mind that under the one purpose test, if you've got one improper purpose, you're in hot water, even if you've got a lot of other legitimate drivers for whatever the arrangement is. So we spend a lot of time in this area looking at the regulatory safe harbors that are voluntary, that can provide some protection, and looking at guidance that the Office of Inspector General, which enforces this statute, has promulgated special fraud alerts and advisory opinions and bulletins. I look at and talk about contractual joint ventures 10 times a week probably. But this can come up with management fees, marketing arrangements, payments to physicians, outsourcing any sorts of services. Stark, I think everyone knows when you've got physicians, you've got to deal with Stark, strict liability statute, when there's a financial relationship in designated health services. We won't go into a ton of detail today, but know that in the MSOPC structure, a lot of the ability to generate value and distribute it is predicated on meeting the definition of being a Stark group practice and meeting a specific exception for the in-office ancillary services exception. Erin and I could talk for 90 minutes about that, but that is key. Also, we've got beneficiary inducement, gain sharing, those come into play when you're trying to do some of the more risk-based programs and entice Medicare beneficiaries to buy from you or to join your practice. Overpayment rule, if there is an overpayment, you've got to pay it back in 60 days, it boils down to. And False Claims Act basically is the enforcement tool that the government uses to enforce all of these fraud and abuse laws and key term relators. And I will skip right there to the next slide, if you guys would. Yeah, we just have a slide here saying that the government is really looking at private equity. The government is saying the government's looking at private equity for antitrust enforcement. States have a lot of laws too. All right, next slide. We've got heightened enforcement of PE by the Department of Justice and in the kickback space too. Some high profile settlements where private equity got pretty involved and even found things in due diligence that they didn't fix on inappropriate supervision or improper billing. So just keep in mind that that liability can flow up the chain. Next slide. Now we've got a polling question, Laura.
Thank you. Our third polling question is, how many states have an active corporate practice of medicine doctrines? 0 to 9 states, 10 to 19 states, 20 to 29 states, 30 to 39 states, or all 50 states? Remember, you must fill out the polling question in order to receive CPE or CLE credit. You'll have 30 seconds to answer. Thank you for participating in our poll. Now I'll hand the presentation back to Erin.
Thanks, Laura. Yes, it seems we're pretty even across the board, but the correct answer is 30 to 39 states. So there are quite a few states that do have an active practice or active CPOM doctrine, which is why the MSO-PC structure is so important. And it's why it's really important for active engagement with the physicians in the platform to ensure a sustainable platform moving forward. And so a lot of our time right now with clients is focusing on how we can engage physician sellers post-closing. So one of the reasons to get out of independent practice is to alleviate the financial risk of practicing medicine, but we are seeing that most platforms and most PE funds want the physicians to still retain skin in the game post-closing and throughout the life of the platform. And so, of course, the first question that we get is, can we do an earnout from a healthcare regulatory perspective? And so we saw an interesting shift with the risk profile during COVID. From a fair market value perspective, a lot of people in the industry struggled with what is the fair market value of the transaction. And so we saw earnouts being utilized throughout deal work. It still contains the same risk profile from a healthcare regulatory perspective, but we're seeing investors being able to swallow that risk a little bit more depending on the subspecialty, if there's specific DHS revenue, if the percentage of DHS revenue. And so it's still a tricky question that's so fact specific, but it's something definitely considered to continue the engagement with physician sellers. There are also a variety of different equity considerations, whether it's a physician shareholder selling, whether it's associate physician who might not be getting purchase price dollars, but want to have that associate kind of engage in the platform post-closing. And there are also a variety of different protections and rollover documents that we can include. Remember, the practice entity that employs a physician is owned typically by the physicians that we're negotiating against, especially in a physician practice deal or a platform deal. And so including certain protections and control mechanisms in rollover documents and having that alignment up the chain is really important for the platform's growth and sustainability. And another thing that we are focusing really hard on is effective compensation models. One buzzword coming around is the EBPC, earnings before physician compensation model. Essentially, PE investors are not purchasing the whole practice, but rather a percentage of it, and having the physicians retain that percentage moving forward in an EBPC comp model. It's a little bit complicated, but essentially the parties split the revenue and expenses based on a scrape, and then they split it up amongst themselves. But if you have further questions on how to structure that EBPC model, Kristen and I are happy to go through that.
Yeah,
Great,
and then just quickly.
Yeah, go ahead, Erin.
Yeah, Michael, jump in here. We listed the post-closing growth opportunities, which include ancillaries. We see that in specialties, adding labs, DME pharmacy, lithotripsy, and that's something we help with during the transaction and after. And then partnership opportunities. We talked before about the role of hospitals in all of these transactions, and I don't think it's an either or with the PE in the hospitals. We work with a lot of PE-backed groups that are doing joint ventures in surgery centers with hospitals, actively in their clinically integrated networks, doing PSAs or clinical co-management. So I think everyone can play nicely in the sandbox.
Exactly. And I know we've got some additional material that will be available on the slides that kind of touch a little bit more on some of those that we're seeing the sectors where that's playing out at. But clearly a topic-filled webinar, a lot of content, that EBPC compensation model especially, a lot of information there. So if you have questions on that, it's very important to actually structuring these. We can all, Erin, Kristen, myself, can help advise on that. So with that said, we've reached our time. Any questions that were submitted, that will be communicated after the webinar to those submitters. We appreciate your time. We appreciate your attention. And I will turn it back over to Laura.
Thank you. And thanks to our presenters, Erin, Kristen, and Michael. If you have any questions, their presentation and contact information will be emailed to you along with a recording of today's webinar. Also, if PYA can provide assistance with audit, tax, compliance, valuation, or physician services, please call or email us. You may also visit our website at pyapc.com for more details about our specific areas of expertise or to subscribe to receive PYA insights. If McGuireWoods can help you with health law needs, please visit them at McGuireWoods.com. Please remember to stay on the line once the webinar disconnects to complete a short survey for CPE or CLE credits. On behalf of PYA, thank you for joining us and have a great rest of your day.